Welcome. In this video, we're going to talk about a different type of liability that companies are increasingly encountering. And this one is an environmental liability. In this example, I'm going to work through it. We are looking at an asset retirement obligation. So let's first read through the exercise and then see how we're going to work through with it. So we have Oil Products Company that purchases an oil tanker depot on January 1, 2020 at a cost of $600,000. Oil Products expects to operate the depot for 10 years, at which time it is legally required to dismantle the depot and remove the underground storage tanks. It is estimated that it will cost $75,000 to dismantle the depot and remove the tanks at the end of the depot's useful life. So this is the issue is not new, but the fact that a company has to do the accounting and disclose it in their books, that aspect is relatively new. So we'll see how we will do the journal entries for the purchase of the asset and then the recognizing the obligation in our books. They've asked us to prepare the journal entries to record the depot and the asset retirement obligation on January 1, 2020. Based on an effective interest rate of 6%, the present value of the asset retirement obligation is $41,879. So they've done the present value calculation for us over here. They've told us the interest rate is 6%. They didn't give us the factors. They've just gone ahead and done the 75,000 times the factor, and they've told us what the amount is. So let's first do the journal entry for the acquisition of the asset. So to start with, my journal entry, I'm going to have the date. The first one is easy. Plant asset debit, cash credit, and it's going to be for the $600,000 for the purchase of the asset. So this one is fairly straightforward. We know how to do it. Now the second one also looks similar in that it is plant assets debit. So that liability that I'm going to have at the end of the year, I'm adding it to the cost of the asset, not end of the year, end of its useful life, which is 10 years. I'm adding it to the cost of the asset. So whatever cost I'm going to incur 10 years from now, I'm bringing that down now, and I'm saying I need to include it, and I'm crediting asset retirement obligation liability. So this is a liability I'm recognizing in my books, and we've already told what the dollar amount is, $41,879. So the total value of the asset is $600,000 and $41,879. That's a combined plant asset. So this is what I bought it for, and this is another expense I'm going to incur, but 10 years from now. Okay. So on this side, what I have over here for me is a small spreadsheet over here, a table over here. And this is basically the calculation of amortization I need over here for this $41,879. I'm going to show you how that calculation is done. Remember, as we had done with notes payable, we are basically looking at a payable over here. We have the present value is $41,879. What should it be in my books at the end of 10 years? $75,000. So I'll show you how to work your way through with that. Okay. At the end of the year, now in part B, they're asking us to prepare the journal entries required for the depot and the asset retirement obligation at December 31st, 2020. We are using the straight line method of depreciation, assuming there's zero salvage value. So the first part is easy. This plant asset has to be depreciated 10 years, straight line method, zero salvage value. It's basically 600,000 divided by 10. And the journal entry is depreciation expense debit, accumulated depreciation credit, and that's going to be $60,000. That's for the plant asset. This number that I have here, I'm going to show the corresponding depreciation as 60,000. Now this plant asset that I have over here, it's the same plant asset, but this dollar amount, let me put this in a different color over here. This also needs to be depreciated. Same thing, 10 years, straight line method, zero salvage value. So 41,879 divided by 10. Again, it's going to be depreciation expense debit, accumulated depreciation credit, and it's this number that I'm dividing by 10. So I could combine these two journal entries, depreciation expense debit, accumulated depreciation credit, and put as one journal entry. I've just done it twice to show you how I came up with these numbers. Okay. Now, here on the side, let me do start the calculation so I can show you my next journal entry, which is also on December 31st, 2020. So the date I bought the asset, I said the obligation has a carrying value of 41,879. This number, the carrying value, beginning carrying value, I multiply that by 6% because that's the effective interest rate to arrive at the interest expense. I add it to the previous carrying value to arrive at the new carrying value. Remember, if you're not sure whether do I add or subtract, just think about it logically. I have 41,879 in my account. It has to become 75,000 at the end of the 10 years. So I need to keep adding it to increase it. So my journal entry I have on December 31st is interest expense debit, asset retirement obligation. Remember this account, I want to keep growing it, so that's what I'm doing here. Interest expense debit, asset retirement obligation credit, and the amount for the first year is $25,513. $2,513 is the dollar amount. So for the second year, the depreciation expense, this journal entries, they stay the same. The interest expense debit, asset retirement obligation, that part is the same, but these numbers are going to change because it's based on the new carrying value. That's a number that comes down over here. Again, I have 6% of that number is the interest expense, and then I have the new carrying value. Now, I haven't been asked for that journal entry, but if I was asked for it, I know how to do the calculation. You can just copy and paste all the way through. Obviously, your interest expense keeps going up because the carrying value keeps increasing. And you will see at the end of the 10 years, I'm off by $1, it's 74,999, which is $75,000. Okay, let's see what happens here. On December 31st, 2029, that's at the end of the 10 years, Oil Product pays a demolition firm to dismantle the depot and remove the tanks at a price of $80,000. What had I planned for? $75,000. But it turned out to be a little more. It's $80,000. Prepare the journal entry for the settlement of the asset retirement obligation. Okay, so in my journal entry, I'm retiring the obligation. How much do I have my obligation at? 75,000. I'm rounding it out to 75,000 is what I have it in my books. How much cash did I pay the demolition company? I paid them $80,000. So what's this difference of $5,000, a plugged number? It's basically the loss on asset retirement obligation settlement. Okay, I'm settling the obligation, I'm finishing it off in my books, and that extra 5,000 is now charged to the loss account. The idea over here is you bought the asset, 600,000, you used it for 10 years. That was the logic for capitalizing it and spreading the cost of the asset over 10 years that you use it. This $80,000 that you're going to spend at the end of 10 years, well, we thought it would be 75, but the 80,000 I spent at the end of 10 years, I need to amortize that over 10 years. I could not do that if I didn't have that obligation in my books, a liability in my books. I needed to have the obligation in my books so that I could write it off over the 10-year period. Once again, the idea is you want to spread that cost over the 10-year period and not take the entire hit in the 10th year. So this was what was happening. Companies were completely ignoring this obligation. I guess they were just hoping and pretending that it was not going to happen. But now that the laws have become a little stricter, the environmental laws, companies are being forced to show this obligation in their books, asset retirement obligation. Now, how do I come up with that $75,000? You ask experts, and it's your best guess. So could a company possibly have put 50,000 instead of 75? Sure, they could have. If they did, all the interest cost would have been lower all along, and in the final year, that loss number would have been much bigger. So if you want to kick the can down the road, sure, you can do that. But the idea really over here is you want to be honest with an asset that you purchased. You know you have an obligation to clean the environment after you're done using the asset. You try with your best guess what the cost is going to be at the end of 10 years to clean up the environment. The discount rate of 6%, again, it's your best guess over here. So lots of guesses that we have with this asset. So this is the last of the liabilities we're talking about in this chapter.